Thank you for coming. My name is Peggy Gachet. I'm a member of the Endowment Board, and it is my pleasure to introduce Tance Roberts. Tance is a local attorney, and she specializes in taxation law, estate and trust planning, probate, guardianship, federal and state taxation, which is a rare commodity around here, Medicaid planning, and real estate law, especially as it relates to estates. Her education is a BS from the University of Florida. Nope, Florida State. She confuses me because she's a Florida State fan, but her law degree that she got from Florida State as well. However, she went into taxation specialty at the University of Florida, so she was a traitor, I take it. Anyway, she has her Master's of Law in Taxation, and there are only about 157 or so Florida Bar Board certified in tax law in the state of Florida. So that is one of about 157 in the state. She is also a member of the Florida Bar Association and on the executive board as a section member for real property, probate and trust law, taxation, and elder law. I Googled that and I went, okay, that means that she actually has a concentrated focus on those areas in select fields of practice, and it opens doors for collaboration and continuing education that others don't have access to. So that is really important. LLM, I also learned, is the Master's of Law, which is also a rare thing, and I doubt there are many in Florida who have an LLM degree. And where is that one from?
That is the University of Florida.
Okay. And you can get those, I'm told, at Harvard and some of the other prestigious schools. So I'm glad that University of Florida offers that. She's a member of the Estate Planning Council of the Fun Coast. I'm not sure where the Fun Coast is. St. Johns County Women's Lawyers Association, and the St. Augustine Professional Advisory Council chair for the Community Foundation, which she's going to talk a little bit about today. What I didn't see on her bio online is what I know about Tance, and that is she has a heart of gold. It is a really, really large heart. She gives a lot to philanthropy efforts in the First Coast. She has a true heart for elder planning and elder law. There's nothing that will make her mad faster than to see people abuse the elderly. So she does a lot of pro bono work in our county, and Tance, it is my pleasure to call you a friend, and I welcome you to Trinity.
Thank you for having me. It is an absolute pleasure to be here. The last time I was here was when my second child, my son, graduated from preschool here. Both my daughter and my son went here from 2-year-old, 3-year-old, 4-year-old, and so I spent a lot of fun times here at Trinity. It's an excellent school and truly appreciated the time that I was able to spend here. So it's great to be back. So yes, I do a lot of estate planning and working with charities and charitable foundations and endowments that you actually have here at Trinity. In fact, and I have a lot of clients, believe it or not, that attend this parish as well, and so I get to know a little bit more about what goes on here through them, and it's quite nice to know. Your organ is very, very popular. I can tell you that. And that's a good thing, but it is a very, very popular thing, and I understand that a lot of people do like to give gifts for the organ to make sure it keeps going. And I certainly enjoy, my office is downtown, and I enjoy hearing that when the chimes ring outside, the bells ring. I really enjoy listening to that a lot of times when I'm going home. It's kind of nice to have. So let's talk a little bit about what's going on with our tax laws and how they affect us in not only our estate planning, but our charitable giving and our charitable planning. So July 4th, 2025, a new tax law was signed by the president and put into place, and it made a lot of the things that we already had permanent. We were kind of in an uncertain time because the 2017 law that had been in effect it was going to sunset at the end of this year in December. And planners and people that wanted to plan for themselves were not sure what was going to happen or where we were going to land with respect to primarily estate taxes. Because that was what had happened was, and let me give you a little history. I'm old enough to know what the original estate tax rate exemption was, and I started practicing actually I became a lawyer in 92, but did not actually practice until after I finished the LLM, and that was in 93, and the exemption was $600,000. So if in 1993, and that was that way for a long time, and it graduated up to, in fact, it was $675,000 before we changed the major tax changes. So let's think about that. You have a house, you have a retirement account, a bank account, and a life insurance policy. Back then, you were pretty much set to have to pay estate tax. So when I first started practicing, everyone would come in to see me, and the first question they would ask would be, how do I not pay estate tax? That was the overriding policy of what their estate plan was going to be. They didn't care about anything else. They just did not want to pay the estate tax. Understandably so, because it got as high as 50%. 50 cents on every dollar that you had worked for and lived for and wanted. So a lot of our planning for married couples stemmed around making sure you would get the benefit of both exemptions for both spouses. We did a lot of trusts. We did, marital trust and credit shelter trusts, and put a lot of planning into effect. Well, along came new tax law changes, and so it graduated up. We had a $5 million exemption, and that raised the bar and level for a lot of people. There were a lot of people out there that didn't necessarily need the estate tax planning for the $5 million range. And certainly, if they did, and for a married couple, that would be $10 million if they planned properly. We still had planning, but people had not gotten used to the fact because for so many years, everybody was so afraid of the estate tax. So they still would come in and ask, I just don't want to pay the estate tax. What do I have to do? Just tell me what to do and we'll do it. We weren't really talking about all kinds of other things that you do in planning, like if you have a business and succession planning for your business, or really getting down to do you have a child or a grandchild in need that you need to do something special for. All of those things were overridden by this huge concern that we were going to pay estate taxes, and we were going to lose upwards of 50% of the wealth that we had made. So come along to 2017. So let me go back. In 2017, we got, like I said, it was going to sunset. We got up to the high range. So this year, before the 2025 Act happened, a single person had an exemption of $13,990,000. A married couple, $27,980,000 million. Well, a lot of my clients do not have that type of wealth. In fact, most of my clients do not have that type of wealth. But like I said, it was set to sunset, and that was going to put it back to $5 million adjusted for inflation, which I didn't do the calculation, but that probably would have been somewhere maybe around $7 million if we were lucky. So that did affect a lot of my clients, believe it or not. If you've got $1 million life insurance policy, and of course, and look at the values of the homes, what they have done in St. Johns County alone, exponential. I bought my house for $180,000 on the Intercoastal Waterway. It's not worth that now. So, but you know, everything has gone up, and if you really start, if you've got a decent I mean, people that worked at Publix have huge retirement plans. So a lot of people would have been affected if it had rolled back. July 4, 2025, the OBB Act came into effect, and it made those rates permanent. And actually, it put it to, just to round it off to start over, in 2026, it's going to be $15 million for an individual, $30 million for a married couple. What does that mean? That means that, you know, about 1 in 800 people who die in the United States will have to pay the estate tax. I mean, way more than 99% of the people out there will not be affected by the estate tax at this point. You know, I did say that the estate tax exemption is permanent at $15 million and $30 million, and it will increase as it's adjusted for inflation. And so now we're going to look at focusing on true estate planning, what you really want to see happen after you pass away. But more than that, we've got to focus on income tax, because now that we don't have to dwell on how do I avoid the estate tax, we can start looking at planning for income tax. But not so fast. Nothing is permanent in Washington, D.C. There is no way that I could tell you or any of my clients, you don't ever have to worry about the estate tax again. Because there is no telling what would happen when a new Congress sits. We don't know. You know, the history of the estate tax was put into place not as a revenue generating tool, but to keep the transfer of wealth from happening over generation to generation to generation. So it wasn't a revenue. I mean, it makes revenue, but it makes hardly any revenue compared to all of the other taxes that we pay. One thing I do talk to my clients about, regardless of where we sit with the exemption for estate taxes, there is a thing called portability. Back when I first started practicing, the only way to get the spouse's exemption taken care of was to put it in an irrevocable trust when they died, so that the exemption would cover that, and then when the second spouse died, they didn't have to count that part in their estate. It was somewhat complicated, definitely burdensome, because an irrevocable trust has to file its own tax return every year. So the surviving spouse is out here not only handling their wealth, but they're having to file a tax return for this credit shelter trust, just so that they could save on their spouses, use their spouse's exemption, and not only be limited to one when they passed away. Portability did come along, and basically that says that we're automatically going to push the first spouse's to die's estate tax exemption to the second spouse, with a caveat. You have to file an estate tax return and elect portability within 9 months from the date of death of the first spouse left. I think actually they have given some further out time for that, and I didn't even think to look at it, but yes, it's a little bit longer than that. But you have to file an estate tax return. You don't pay any tax, but you have to file an estate tax return and elect portability for the first spouse to die's exemption to go to the surviving spouse. Why do I think that that's important? I don't think that's important for someone that has a house, a bank account, and a car, okay? But I do think that's important for someone that has a retirement account, a house, maybe a second home or a vacation home, a large retirement account, maybe some larger insurance policies, or future inherited wealth from their family members. Because what if we do go back to $5 million? What if it's even worse than that? And you haven't taken advantage of taking that portability and applying it to the surviving spouse. And now the surviving spouse is looking at, they've got all the wealth in their name, and now they're looking at whatever law is in effect when they die, and all of a sudden they have an estate tax problem. So I always look at and talk with my clients, do we need to look at portability when the first spouse dies or not, and let them make the decision of whether or not it's worth making that election so that they will not lose the first spouse to die's exemption. Now let's talk about income tax. Income tax got changed a lot. In fact, in order to remain board certified as a tax lawyer, I have to do 125 intermediate to advanced tax law continuing legal education courses every 5 years. Now, I just found out that I'm getting old enough and have been doing that. Actually, I was very young when I became board certified, just for clarity. But I'm going to get grandfathered in pretty soon, and I don't like that term because that cannot be possible that I could be old enough to have met some milestone that I don't have to, keep proving myself out there to be an expert in my field. But that kind of crushed me when I learned that, that's only for old men, not young at heart girls. But anyway, so we've got a lot of classes right now going on because we actually have something new to learn. For a long time, it was status quo, nothing really changed. You just kind of looked over the same thing that you had done. I'm taking them nonstop now. It's fantastic for me because I love to learn all the time. So when we're talking about income tax, what are we thinking about? Itemized deductions or not. So itemized deductions are medical and dental expenses if they're high enough, over 7.5% of your adjusted gross income. Believe it or not, I was in a car wreck one year, a long time ago, and I did itemize my medical expenses. State and local taxes. In Florida, that's real estate taxes and sales tax. We do not have an income tax. But in other states that have an income tax, that includes their income tax. Home mortgage interest deduction on interest and the points you pay on a loan, as long as it's to purchase, buy, build, or improve your home. Casualty expenses for federally declared disasters, which unfortunately we've seen too many here lately. I will have taken advantage of this deduction 3 times. Matthew, Irma, and the last one we had. So as long as it's a federally declared disaster, we are allowed to deduct from our income those expenses that are not covered by insurance. And charitable deductions. Charitable deductions can be gifts by cash or check, and gifts other than by cash or check, like tangible personal property to the thrift store, or cars or boats, or stock, which we're going to talk about in a little while, or real estate. So in 2017, when the first major changes to the income tax law happened, the standard deduction went up. It went up to $15,750 for singles and $23,625 for heads of household. And actually in 2025, that's what it's going to be. I'm sorry, $31,500 for married couples. So it went up a couple of thousand from the original 2017 Act. So if you're a married couple and you have $31,500 as a standard deduction, you have to exceed that in your itemized deductions in order to get any more deductions on your income tax return. We have, and depending, this is a new one, depending on your income level from 2025 through 2028, those who are 65 or older can take an additional separate deduction of up to $6,000. That is income dependent. There is an income level threshold, but if you do not exceed that, 65 and older will get an extra $6,000. So, you know, now you're talking about $37,500 or more if both spouses are over 65. So itemizing deductions kind of went away for quite a few people. Just so you know, our current tax rate stayed the same from what they have been, and that's 10%, 15%, 22%, 24%, 32%, 35%, and 37%. I'm old enough to know a 70% income tax rate. 70%. There were a lot of more deductions back then when you had a 70% things that you could deduct. And then we have the capital gains tax rates. And for long-term capital gains, 0% depending on your income, 15%, or 20%, and that's all income, taxable income dependent. And short-term, that long-term is anything you've held for more than a year. Short-term capital gains remained at your regular, ordinary income tax rate. You've held a capital asset for less than a year. And then we have the Affordable Care Act tax, and that's 3% that they tack on top of your capital gains. So, you know, again, if you don't have to look at the estate tax worrisome anymore, why not look at what can we do on the income tax side? We also used to have limits based on our income of what charitable deductions you could take even if you were itemizing. Just like we have the limit on what you can deduct for medical and dental based on your income. It used to be 50% for cash donations to what we call 501c3 organizations. Church is a 501c3. They are considered to be pure public charity. So now they've raised that to 60% of your adjusted gross income. They're trying to incentivize charitable giving to public charities. But at the same time, reduce marginal tax rates. If you're in the 10% tax bracket, a tax deduction of 10%, if you give $1,000 to get 10% off your taxes, you're only getting 10% of $1,000, $100 off. You spend $1,000 to get $100. That's not really incentivizing too terribly much. So it depends again on where you sit in the tax brackets. And then by well more than doubling the standard deduction and more than doubling the estate and gift tax, have we diminished the tax incentive for giving? So one thing that the 2025 Act did is you can now deduct $1,000 as a single individual or $2,000 as a married couple above the line. What does above the line mean? We don't have to itemize up to $2,000 for a married couple of charitable deductions. So if you have a married couple has $2,000 of $2,000 or more of charitable contributions for the year, then basically you can just deduct it right off of your taxes. You don't have to itemize. So that is in addition to your standard deduction. We had this in 2020 during COVID. It was a $300 above the line deduction for charitable giving, and about 90 million taxpayers claimed it. So I'll venture to guess that a lot of, because if you're not itemizing, but you can still claim this, you're going to claim it. And then the ultra wealthy did get a little bit of a hit on the charitable deductions. If they itemize, then, and they're at the 37% tax bracket, they only get to take it off at the 35% tax bracket. But you're talking about, $1 million+ of income, of taxable income. So we're not talking about regular people that aren't in the more wealthier class of people that make, $1 million plus is a lot of money to make every year. So they did take that little 2% back, that regular people would get. But again, we only get it at our tax bracket, which might be the 22 or the 25 or the, maybe the 32. We have a new law, again, they always have to do stuff, it's tough to make it complicated. We used to not have a floor of which to be able to deduct our charitable giving on our income tax returns if we itemize. But now it has to exceed 0.5% of your adjusted gross income for a given year to deduct it. So, for example, let me give you an example. I like that. If you have adjusted gross income of $300,000, you can only deduct charitable donations in excess of $1,500. So the higher your income is, the more charitable deductions you would have to give in order to be able to deduct them on your tax return. Corporations are now going to be limited to 1%. It has to reach 1% of their adjusted gross income. What's the implication on that, of these things that I've been talking about? High income individuals who itemize deductions should probably think hard about this year, because it's not in effect in 2025. That goes into effect in 2026. So one of the strategies I'm fixing to give you, you'll understand why in planning you might want to really think about it for this year instead of years in the future, and that's called bunching, and we'll talk about that a little bit later. One thing of interest for not the endowment that you have for the church, but you do have a preschool, which is going to be another school, and that school is going to grow into an elementary and secondary school, potentially. And we have a $1,700 non-refundable tax credit. A tax credit is way bigger than a tax deduction. That means dollar for dollar tax you paid, you get back. And that's for charitable contributions to organizations that grant scholarships to elementary or secondary students for federally defined poor families. So that could be of big benefit with respect to the school that the church supports. There is a I talked about the capital. All right, let's talk about, and I'm going to talk about this in a planning sense. So I want you to understand what the state and local tax deduction is. Prior to this new law, there was a limit put on state and local taxes of $10,000. Not sure what your real estate taxes are in St. Johns County. Mine on my homestead are only the way that they are because my home flooded in Matthew and it got reduced to that value, and I get the 3% cap every year on the lower value. I pay the taxes gratefully not to have had that flood, but that is what it is. At least I get some benefit on the tax side for having to endure that. But the $10,000 has now gone up to $40,000 for taxpayers making under $500,000 for 2025 through 2029. A lot of planning is going on around this very thing, and I'll tell you why in just a minute. And then there's an endowment tax, not for yours, but they have introduced a tiered tax system and higher tax rates on university endowment investment earnings. Maybe one day Trinity will get that point, and they'll have so much investment earnings that they'll hit this, but Harvard is the prime example of where they're going after, because they have so much wealth that they're sitting on and don't even use, and that's what that is out to hit. So, would a tax law alter both the direct financial, benefits of donations? I mean, the law does affect it. You've seen how I just told you how it affects it. If you don't itemize deductions, you get that standard deduction whether you give one dime to charity or not. But back to when we first did the higher standard deduction, if you look at charitable giving, you're going to find out that those of us that do charitable giving, we don't really look at the tax consequences of it. I look at how can I best use the tax code for my benefit, to once knowing that I'm going to give charitable giving, but I don't look at charitable giving, and I venture to guess that most of the people that are in this parish don't do it either, because you support a Christian ministry. And all of the surveys out there say that beyond everybody else in our communities, that those that go to church are the ones that give the most. Not just to the church, but to all of the other organizations as well. And I know it's not just money that everybody gives, it's time and talent as well. So we've got some incentivizing provisions in the tax law, that $1,000 and $2,000 above the line deduction. That would incentivize someone that maybe not is inclined to give charity to go, well, if I give it, I can get the tax deduction, so I might as well do that. It worked in 2020. A lot of people took advantage of that $300 tax deduction. And then the scholarship granting tax credit, which is huge, and the increased SALT deduction cap. I have other properties beside my home, so my real estate taxes combined are more than $10,000. And that's not to mention the sales tax that we pay. And if you buy a large item like a car in 1 year, that could be a very large sales tax burden as well. But we've talked about the ones that disincentivize giving. And so why don't we look at how can we get around that? What do? How can we get around that? I'll tell you how I did it when this came out. One good thing about being a tax attorney is you learn what's going on ahead of time. My family was probably one of the first families to have a health savings account, because I knew it was coming. I read the law before they ever signed it. And there was only one bank at that time. It was called HSA Bank, Health Savings Account Bank. And it was somewhere else, and I had to find it. And I got my health savings account so that I could deduct it from my taxes. But the health savings account was hugely beneficial, even if I didn't get as great a tax deduction, because it was saving money for future medical bills. I just happen to like to get the tax deduction. It's another one of those that comes off the top. And I like a lot of those. You don't have to itemize your health savings account deduction, just like you don't have to itemize your retirement deductions. So when I saw these higher standard deductions and realized I wasn't going to be itemizing anymore, I'm like, how do we work this? So I did what's called bunching. But I also took advantage of another thing, which we'll talk about. And the bunching was, okay, I know that I'm going to give X amount of dollars per year for charitable giving. I know how much I'm giving my church. I know how much I'm giving to this organization and that organization and this one and that one. Why don't I give 2 years in advance and skip a year? So now I've doubled the amount of giving that I gave in this year because I've given both years ahead of time and increased it to the point, and then same thing with your real estate taxes. If you're in, now that we have this $40,000 deal, the $10,000 wouldn't work so much, but you get $40,000 off. Okay, all right, I'm going to time it where my real estate taxes, and I'm going to buy that car, and I'm going to do all the things that I need to do to itemize deductions this year and not worry about it next year. Or maybe the next 3 years, depending on how it is. So, but what I also did was, I said, well, if I take money out of my pocket and I give it, that's cash. Cash is cash. $1 equals $1. But I had this thing called Apple stock. And I got that Apple stock when Apple first came out. And that Apple stock grew really a lot. And if I were going to sell that Apple stock, I was going to have a very large capital gains tax on that Apple stock. So what did I do? Not only did I bunch the contributions up, but I used my Apple stock and donated the Apple stock to the charitable foundation and got 100% tax deduction for the fair market value of that stock, and I didn't have to pay the capital gains tax because I didn't sell it. The charity sold it. So that's what we talk about when we're talking about appreciated assets, real estate, stock, anything that's appreciated, anything that you have built-in capital gains has been sitting around forever and ever. Something you may have inherited from a family member that, they barely, it was barely worth anything when the person passed away, and now it's worth, 10 times that. You're going to pay the capital gains tax if you sell it, but if you donate it, you're not going to pay the capital gains tax, and you get 100% fair market value to be used to reduce your income taxes. So the disincentivizing provisions that are in the code, the Congressional Research Service estimates that it will cost about a 10% increase in the after-tax price of giving for individuals. They thought that it would lead to a 5% decrease in charitable contributions, and this was the earlier on when they raised the standard deduction. It's not clear whether these new changes are going to disincentivize or not, but I will tell you that under the prior law before 2025, the 2025 Annual Report of Philanthropy, of the $593 billion in charitable giving in the United States in 2024, which we were under the old law, but it still had high standard deductions and lower marginal income tax rates, that it was effectively the same as before they did these disincentivizing provisions. Most of the giving, of course, is by individuals. They come, so individual giving is about $392 billion. That's 66% of the total charitable contributions that are given in our country are by individual people. Foundations give $110 billion, but a lot of the foundations, individuals gave to them before the foundation gave to them. And yes, you do have, we have the Community Foundation for Northeast Florida that covers St. Augustine, and it does a lot of the foundational giving to charities in St. Johns County. One is the Crisp Ellert Art that happens in St. Augustine. She donated a lot of money to the foundation. And Doris Bar Weaver from the Jaguars gave a tremendous amount to them. And the Winn-Dixie family, when they closed their foundation, put theirs into the Community Foundation for Northeast Florida. We actually have a very large one around here. That's where I gave my Apple stock to get that donation. So now I tell them every year, pay this amount to my church, pay this amount to that, pay this amount to that, and they pay it out. It's called a donor advised fund. So even though the number of people that are claiming the charitable tax deduction on tax returns fell, because they couldn't itemize their deductions, the giving levels remained the same. So, yes, ma'am.
Okay, let me make sure I understand this. If in fact you have $100,000 donation in stock to the Community Foundation, for example,
Or the churches.
or the church,
Endowment.
or whatever endowment, then you get the tax write-off of $100,000, right?
Depending on your income, yes.
Yes, okay. And then you can direct that foundation or endowment to distribute the money in intervals or amounts for the next year or two.
Yes.
But you're
Or however many
taking,
years,
yeah,
yes.
but you're taking that deduction in year one.
Yes. Yes. Because you gave it to a charity.
Right.
Yes. So a donor advised fund, basically, I mean, can the foundation reject your request? Yes. I've never heard of it happening, and I don't know under what circumstances that would happen. But I mean, if you're giving to your standard organizations that you've been given to for, I mean, they're not gonna tell me that my donation to Memorial Presbyterian Church is not gonna happen. They're gonna write that check, and they have been. Now, there are certain exemptions from that. My Seminole Boosters contribution that doesn't go to capital campaign, yeah, I can't do that through that, but, because I get tickets. But they are limited with what it's basically for what you think of as public charity, not
Okay.
for, right, that you don't
And-
get benefits from.
Okay, I asked our accountant for the church if we had the ability to bunch, if you will, and she was unaware at this point. However, they are researching the ability to do something like that. They just don't really have the mechanism yet.
Okay, so when I mean by bunching, what I mean by bunching is I give annually to the church and other foundations. Other charities. I give every year, okay?
Okay?
And
And you give that directly or through the community
I
foundation?
used to, I gave it directly until I did this through the Community Foundation for Northeast Florida. So there's also psychological aspects to this as well. Every year, and I'm sure your church is probably similar to mine, we have a stewardship committee. We have a group that says, hey, we have a budget and we have to perform on that budget, and we'd like to know what your pledges are for this year, and please let us know what you think what you're going to be giving to the church so that we can put it in our budget. When you bunch, you're prepaying. And you got to get your church around the fact that you're prepaying, and that just because they got a large windfall for this year, you're not going to get that from me next year if I were to give it directly to the church. You're not going to get that from me next year, so you need to act accordingly. Churches are set up for annual budgets, annual stewardship, annual campaigns, annual. That's what they do. And a lot of people are, every week they put in to the plate. because that's the way they do it. So it's a whole different ballgame when you're talking about churches and the thought process on how you give donations and how they perceive your donations. Because you don't want them to think, well, Peggy gave us a lot of money last year, but she's not giving us a dime this year. Oh my, that's not, we don't want that to happen.
So from an endowment board perspective, let's just say that Peggy wants to sell 2 stocks she's made a big capital contribution on. And if she gives her Apple stock like you did to the endowment board, then she can take that as a tax deduction.
The fair market value of it at that time.
Yes.
Mhm.
And if she wants to sell the other one, she can just pay the tax on it or do both. But I want to clarify that our endowment board does not allow the distribution per the donor. When you give to our
Oh,
endowment
no,
board.
no, you have I would venture to guess, though, that you do have the ability for someone to say, I want this to go to brick and mortar and not for the annual budget.
Yes.
Right. So, I mean, there
And-
are a few things that can be done.
And the benefit of that, the other part of this, the way I'm thinking from our endowment board, is if Peggy has made a lot of money this year and doesn't want to pay tax on that money, by giving the stock away, she is mitigating her tax bill. Because
Absolutely.
and that's what I think we need to help people understand.
That's what I'm here for. That's exactly what I wanted to impart. You got exactly where I am going. Fantastic. Yes, absolutely.
Now, let me ask you one other thing. Does the church have any benefit to this? We've made more money this year. And I know we're annual. Does that have any benefit for the church because we don't pay tax? Is there any way the church has a benefit from getting a lot of extra donations?
It's a budgeting process. You're going to have to talk to the people that do your budget.
Okay.
I mean, what I'm saying is the budgeting, if instead of going through the Community Foundation for Northeast Florida or another type of organization like that, where I have a donor advised fund, I mean, Fidelity has a donor advised fund. There's a lot of donor advised funds out there. Instead of going through that, if the church would embrace understanding, hey, I did really well this year, and I want to give you even more than I would on a normal year of doing well. I want to give you double what I would have normally given you, even given my money, but I'm not going to give that next year. You need to act accordingly inside of your budget, because if you take that and spend it because you have all this extra money, we can add it into our budget. We've got churches always have needs. We have this need, we have that need, we have this need, and then it's gone. We'll come around next year, the money that every year you got from that person is not going to be there in that budget unless you said, okay, let's understand that we're going to put this in reserves. Have a reserve fund, right? Reserves. Now, your endowment is different. Okay, so your annual budget is different than your endowment. Your endowment is taking assets, and they are only paying off the income generated from those assets in order to provide the needs of the church. So if someone giving to the endowment, not necessarily doing that every year, if they want to give to the endowment, if they give a big lump sum, no one's thinking about that. I'm talking about the people that are giving their annual contributions and bunching them up and giving a larger amount to try to take advantage of a tax. And why not? Why not let them? Because they can give you more money if they're paying less money to Uncle Sam. We've already talked about the fact that giving didn't go down. So the givers are not tax driven. So if you give them, they're already going to give. Now you give them an incentive to get a tax break, they're probably going to give more because they're givers anyway. Yes.
From an endowment standpoint, you talked about donor advised funds. somebody wanted to donate, is the endowment able to set up an a donor advised fund?
No.
You have to go
A
through
donor-
somebody
A
else.
donor advised fund is for different, is for different fields of interest. Because I give to Rotary, I give to capital contributions to Florida State University. I give to the law school. I give to
That's okay.
the University of Florida Law School. Oh. I do. I give back because they gave me something. And my daughter laughs all the time when the gator comes in the mail. Mom, they sent you a gator. I'm like, I know. But I did wear garnet and gold every day I was at school. I did not wear orange and blue. I will not wear orange and blue, and you will not see me in orange and blue. And I'm sorry for all the gators, but I'm Florida State through and through. But so it's different fields of interest. So giving to the church is different than giving to the Florida State University Law School or the Florida State University Arts and Sciences program. So that's what a donor advised fund is for. You have one interest, the church. Well, you have two, the school and the church, but they're one and the same. I'm sure you have different line items of money parts, but it's all the church. But yes, so if somebody could, but I said, usually churches divide it between operating, day-to-day budget, and capital. That's your distinction.
If somebody wanted to set up a donor advised fund with some other organization or with an investment firm and direct them to pay the church and something else from that on an annual basis, that's possible?
Right.
Okay.
That's the community foundation that she set up.
Right. And like I said, the Fidelity's out there and the other kind of, and I'm not touting them, I just happen to know that they have, most of those types of organizations have the ability, they have it set up where you can do a donor advised fund through them. But that's just a specific tool. Cash donations to the church count just as much as a cash donation to a donor advised fund. So where you give it, but yes, I mean, if your endowment board could set up an account that people could give highly, whether you have it or not, I don't know. But if you have it, great. If you don't, and you do set it up where you can get highly appreciated assets and sell them, I can guarantee you I gave more because I was given Apple stock than I would have writing a check out of my checkbook.
We do have that ability to accept the stock and liquidate the stock.
Very good.
So that's not so much the question, but let's say if we donated Apple stock to the community foundation, then in theory, you could direct them to pay 50% of that 1 year to the church and 50% the next year to the church. But you are getting the tax write-off for that 1 year that you gave the Apple stock.
Correct.
So that's the way you bunch it
Correct.
together.
But of course, a foundation has built-in expenses. And I mean, trust me, I'm a big proponent of the foundation. But if you have people in your church that don't have other fields of interest and all they're wanting to do is benefit the church, then use what you have to do that very same thing. And just understand if it's going for your annual budget that money over 2 years, not, or however many they tell you. Communication with the people as to why they're giving, and not a I need you to give, but thank you for giving. We want to make what are your thoughts about it? But if you talk with people about this particular ability to take advantage of an itemized deduction year, a person that had the casualty loss through this last storm, because our water is coming up high on hurricanes, and my house gets surrounded every year now when it never got surrounded before Matthew hit. So I had a bulkhead problem with that storm. I had a driveway problem, a sidewalk problem, and all my plants and grass, everything died again. And so I was able to write off the amount of money that, because, insurance doesn't pay for grass, and insurance doesn't pay for bulkheads, and insurance doesn't pay for all those things. So that would have been the year that I would come to the church and say, hey, okay, I'm going to give you 3 or 4 or however many years in advance, but understand that I give this amount every year, and I have for years and years and years. I'm going to triple it, but I mean for you to budget that over 3 years. I'm able to do that because of my knowledge. We've got to educate people to be able to take advantage of those things that are right there in there. And if you're in the 20% tax bracket, that's 120%. Because you didn't have to pay that 20%. So let's talk about some other couple of things that are some items that could come in. Okay, obviously, I'm sure that you all being on the endowment board understand the required minimum distributions coming to the church for tithes and for contributions to the endowed fund. They have to come straight from the institution. So it never hits your income tax return if it goes straight in. And most, a lot of people have to take required minimum distributions that they do not need. But it adds to their tax consequences, and sometimes it throws them into a whole new bracket. Sometimes it takes away things that they otherwise would have had the benefit of because they were forced to take the required minimum distribution. So getting required minimum distributions paid in is a huge tool and a huge selling point. Because if the person takes that, and they can do part of their required minimum distribution. By the grace of God, if I live long enough to get mine out, or have to get mine out, part of my required minimum distribution will be used every year for the church. Why would I take money in, pay taxes on it, and then give it to the church? That makes no sense. So you don't have to give all of your required minimum distribution, but whatever portion you do give, it doesn't even come into play in your tax return. It didn't exist. So that's a huge, huge thing to do. So we've talked about appreciated property. We've talked about bunching. We've talked about what a donor advised fund does, how you can use it in your annual budget with the bunching. We've talked about the IRA, RMD. Now let's talk about certain type of trusts you can do. We have 4 different types of charitable trusts. And you have 2 main types, and each have 2 under them, under the types. There's a charitable remainder trust and a charitable uni trust. We always like acronyms in my world. UNI.
UNI?
UNI trust, uni trust, okay? So it's the CRAT and the CRUT. So the charitable, I'm sorry, you have a charitable remainder trust and you have a charitable lead trust. Those are the 2 types. Under them you have remainder trust and uni trust of each type. So the remainder trust, a charitable remainder trust says, I am going to hold money or hold my assets in this trust, and my beneficiaries are going to get the benefit of it. They're going to get the income from it for either the rest of their life or for a specific fixed time period. And at the end of that period of time, whether for life or a fixed period of time, whatever remains in that trust goes to the charity. Okay? So the remainder trust is the beneficiaries are currently getting it. The charity gets the remainder. The lead trust is just what it sounds like. The charitable lead trust is the charity is the first beneficiary, and the charity gets the money from the trust over a period of years, and then the beneficiaries get the balance. So the remainder trust, the beneficiaries are first, charity, remainder. The lead trust, charity is first, beneficiaries are remainder. Under the remainder trust, you have the charitable remainder annuity trust, the CRAT, and the charitable remainder uni trust, the CRUT. The charitable remainder annuity trust is just what you think it is if you know what an annuity is. That is a set payment that will be non-changeable, and the set payment can be for the rest of the beneficiary's lifetimes or for the terms of the trust. And you could only do a one-time contribution to a charitable remainder annuity trust. It's a one-time deal. You can't add more money to it because the annuity is set on that individual contribution. So you can use all the tools I've already told you about. You can give highly appreciated property to a charitable trust, get the current deduction. The charitable trust sells the asset tax-free, and your beneficiaries can still get some benefit of it, whether it be at the beginning of the trust or at the end of the trust. So a uni trust differs from an annuity trust in two significant ways. And that is the beneficiaries receive a fixed percentage of the trust, not a specific amount. The annuity is a dollar certain. The uni trust is a fixed percentage of the trust. So if the trust grows, the more money comes out. If the trust doesn't grow or gets less money comes out. So it's specifically tied to the value of the trust. Secondly, a charitable, a uni trust, you can add more money to it continuously. Again, taking advantage of all of the things that we've talked about, putting a whole bunch of money in it at one time, putting a highly appreciated property in to get your income tax deduction. We used charitable trust primarily in the estate tax arena because we were avoiding estate tax. And now that we have so many people that don't have to avoid the estate tax, we can take a look at the charitable trust and see if they fit. So the charitable lead trust, again, has the annuity trust and the uni trust. And again, same as with the remainder, but the annuity trust, the charity gets a set dollar amount every year, and the uni trust, the charity gets a set percentage of the value of the trust every year. And then at the end, the beneficiaries get the money. And, yeah.
In the 5 minutes or so that we have left, the favorite, based on the current tax laws, would most likely be the uni. Is that?
No, they completely depend. The tax consequences are the same. But the uni, you can add more into it if you are going to do that. And it all depends. I would venture to say that someone that is 85, 86, 87 years old probably wants an annuity trust because it depends. It depends on what kind of income they need. It depends on what the assets are. It depends on what the goals are of the person. It depends on, it's a highly personal decision when it comes to which way are you going to do, which one are you going to do. Also, it's a highly personal decision. Are you going to do a remainder trust or a lead trust? And it also depends on, do your beneficiaries need the money now, or they're set and they don't need it till later on. So it's just all fact dependent. So, and I just have one more thing to say about the little 5 minutes thing to do, and it's kind of a fun thing that I'm working on right now, and I'm going to write one up. An irrevocable trust, which the charitable trusts are irrevocable, but you have charity inside of them. So that's not dealing with the tax. I'm going to give you another tax advantage thing that does not have to do with charity, and that's called an intentionally defective grantor trust. A grantor trust, the grantor, the person that set it up, is taxed on whatever happens in that trust. A defective grantor trust, the trust is taxed on whatever the trust generates. I've already told you, my husband and I are getting $31,500 of standard deduction no matter what, one dime comes out of my pocket for anything, for any reason. We're getting a $31,500 deduction. But say I want to give, but I can take assets and I can actually put them in an intentionally defective grantor trust and have the trust pay the charity, and it gets a deduction from the income that it earned. And it won't have anything to do with my $31,500 because that trust stands alone. And I can even do better than that. I can make it a spousal lifetime access trust that's intentionally defective, and whatever doesn't go to the charity comes back to my spouse. So I'm not losing any money. I'm working on that right now. That's the new gig out, is this intentionally defective. We've used intentionally defective grantor trust for many reasons for many years, but never in the thought process of using, and in other states that have the income taxes and the things where you need the $40,000. So I get a $40,000 on my itemized deductions over here, and the trust gets $40,000. That's $80,000 of state and local state and local tax deductions. So that's why this is coming out in the terms of the income tax side. An intentionally defective grantor trust has to have an adverse person in it. So I'm going to name my daughter, and I'm going to explain to my daughter about charitable giving and that some of this money needs to go to charity and not all to her or to my husband, and hope that she respects my wishes and understands that that's only one part of an inheritance that she will get one day. But it does have to have an adverse party in order for it to work. But again, we have tools that are able to be utilized to help the otherwise givers that are going to give no matter what the tax code says, to take advantage of it. Why not? And probably the institutions that are accepting the charitable donations will get more. So I mean, that's basically my spiel, and I will say one thing. Being a tax attorney, and especially being a board-certified tax attorney, having to learn all the time, don't think that I don't do regular estate planning. What I think my benefit to doing all kinds of regular estate planning is that those little things that I just told you would not have come out in a regular estate planner. So I look at everything from a tax perspective as well as the regular run-of-the-mill stuff. So, and I appreciate you having me.
Thank you, Tance. We appreciate you a lot. Again, it's Tance Roberts with Matanzas Law here in town, and we will have her back. Thank you.